SpaceX halved the cost of access to orbit, deployed the world's largest satellite constellation, and routinely lands orbital-class boosters on autonomous ships. Now, they have completed the largest initial public offering in stock market history. This chart compares the $75 billion SpaceX just raised against the previous U.S. record. That was Alibaba in 2014, and SpaceX has pulled in more than 3 times that amount. It is easy to look at the successful rocket launches and assume the stock is a guaranteed win. But building rockets and building wealth operate on entirely different physics. Before jumping in to buy shares, investors have to answer a simple question. Does a world-changing company automatically make a profitable investment? The allure of getting in early on a promising company usually points to one benchmark: Amazon in 1997. When Amazon listed, it was an unprofitable online bookstore that had been operating for only 2 years. It lacked the cloud computing and global retail infrastructure we recognize today. This chart shows Amazon's stock from 1997 to 2026. The macro upward curve creates the illusion of an easy climb. But zooming in on those early years, the growth is invisible. The line is flat and volatile. In the moment, the future is opaque. Peloton shows us exactly what happens when investors confuse a temporary trend for a permanent reality. During the global lockdowns, millions of people were exercising at home. Peloton built a passionate community of 7 million members. The market consensus decided that physical gyms were obsolete and home fitness would dominate forever. This chart of Peloton's stock highlights the massive 2021 spike and the subsequent deep, prolonged crash. Lockdowns ended, gyms reopened, and demand slowed to normal levels. The buyers were right about Peloton making a high-quality product. They were wrong about the macroeconomic environment of the future. Rivian presents a different hazard. It stands as a prime example of a solid company hindered by impossible IPO expectations. When the electric vehicle maker listed in 2021, they had successfully developed an all-electric pickup truck. They had corporate backing from Amazon and Ford. The operational fundamentals were strong. The opening day hype pushed the share price past $100, briefly valuing this brand new company at nearly $100 billion. This chart compares Rivian's $100 billion valuation against the combined market value of established giants like Ford and General Motors. This chart tracks the sharp, immediate decline of Rivian's stock price from that initial high point. The company wasn't a fraud, and they delivered trucks to customers. They simply could not grow fast enough to justify the extreme optimism baked into the price. Rivian's ultimate obstacle was its own share price. The company had to deliver perfect execution just to stay level with the extreme growth the market had already paid for. We can apply these lessons straight to the broader financial market. You can be entirely right about a company's quality and its leadership, but be entirely wrong about the price you are prepared to pay for it. This creates the expectation gap. When a valuation assumes years of flawless success on day one, even minor operational hurdles can trigger a significant price correction. Looking at this chart of the newly listed SpaceX stock, we see volatile up and down candlestick movements in June 2026. The market is actively trying to determine where the company's true value ends and the excitement begins. Will SpaceX experience the long-term realization of Amazon? Will they suffer the misjudged macro future of Peloton? Or will they face the crushed valuation of Rivian? A company's past achievements are clear, but its financial future remains unwritten. Separating your admiration for the rocket from the hype of the valuation is the only way to navigate an IPO.